To another video here on Financial Friends. Today we are going to be discussing some stocks I will continue to buy no matter what the economic conditions are like. If you're new to Financial Friends, go ahead and hit that subscribe button. It is free and takes just a second. We're on the road to 1,000 subscribers by the end of this year, so I do appreciate your support in that regard. And also hit the like button as well. Especially if you're already subscribed, go ahead and hit the like button. It takes probably half a second and it really does help out the channel. So today we are discussing some stocks I will buy no matter the financial conditions. We are nearing a potential recession. We will get that result for the second quarter GDP towards the end of this month. We did already see a decline in US GDP growth at the beginning of this year in Q1 of 2022. If we see another decline, we will be in a technical recession. Now, of course, in actuality, the real things that do affect people are not just seeing negative GDP growth, but what comes with that. Loss of jobs, less capital, assets depreciate, etc., etc. So here are some stock picks that I personally have. Again, this is never financial advice. These are the companies that I will continue to buy based on my research and my criteria. Here they are, and let's go ahead and dive into things. Now, I first will dive into the criteria. We're going to use years of consecutive dividend payments and actually dividend increases to see how safe a potential dividend is. I'm a dividend investor at heart. All of these companies do pay dividends, and so for that reason, we want to make sure it is safe and protected and has been proven over the course of a long period of time. We want to see if their industry or sector is recession-proof. Is this a sector where consumers, businesses will spend less in during times of hard times, really hard financial times? If you have less cash in your bank account, are you going to spend less in this area as a result of what is going on? Next up here is both free cash flow and payout ratio. Does the business generate cash that they can use? Free cash flow is the amount of cash the business has, less the different expenditures. Can they continue to generate, and have they generated free cash flow over time? And then take net income. Take the amount of dividends that they pay out of that. Are they paying you 100% of their net income? Are they paying you 80% of their net income, or less than 50% of their net income? We're going to take a look at that using payout ratio. We're also going to use the net debt to EBITDA ratio to take a look at how financially healthy a company is. Net debt to EBITDA is the total amount of debt, subtract the cash and cash equivalents, or things you can turn into cash very quickly, put that over earnings before interest, taxes, depreciation, and amortization, and you will get the net debt to EBITDA. Now, we do not want to see a ratio of 3 or higher. Really in the 2.5 plus categories where you begin to get risky. We do not want to see that. However, we do have one company that is a little bit high in that regard. We want to see this because we want to make sure that companies are not in financial distress at any point. Of course, there are nuances and things that can change. Companies can make investments and then, as a result, have a higher net debt to EBITDA ratio. But nonetheless, those are the things we will be judging these companies on. And without further ado, here they are. Number one is going to be Johnson & Johnson. Johnson & Johnson has increased their dividends now for 61 years in a row. Absolutely crazy. The performance over the last 5 years has been solid, an increase of 32.31% in their stock price. We love to see that, of course. They do operate in a business segment that will continue to do okay during times of recession, that being the medical, pharmaceutical, and kind of consumer health space. They are actually taking their consumer health business and taking it away from the medical device and pharmaceutical products, which will bolster the medical devices and pharmaceutical products portion of their business, or new stock, so to speak. But for the time being, all three of these spaces are relatively recession-proof. Surgeries and major medical things still continue to need to get done. People still will need their pharmaceutical products to stay healthy and stay happy. And then in terms of medical or personal health type of devices, things like Tylenol, Motrin, Aveeno, Neutrogena. These are businesses that Johnson & Johnson owns, and people rely on these products to keep their appearance up, to feel good. And so we will continue to see people purchase those products. They do have a extremely low net debt to EBITDA ratio. The website I was using, Finbox, had them at a 0.00 times. Very, very low debt amount. they're able to destroy that with the earnings that they do generate. Now, in terms of those free cash flows, you can see basically a line straight down or straight from the bottom left upwards to the right. We do really like to see that. It is stable, it is consistent, and it is increasing. In terms of dividend payout ratio, they sit very, very pretty at a 56.28%. That means roughly 44% of their net income is not being used and can be used in other type of scenarios, not just dividend payouts, of course, which took up 56.28% of their dividend payout. Now, moving forward, we have Procter Gamble with 5 additional years of dividend increases coming in at 66 years. Procter Gamble has seen a 67.28% increase in their stock price over the last 5 years. That past performance is no indication of future performance, but it does mean that both of these businesses, and really all of the businesses on this list, can continue to perform year in and year out, because there are companies over the last 5 years, even in a massive bull run, that have not done as well as these. Net debt to EBITDA is sitting really pretty at 1.2 times, and in terms of the business, the way that they operate, they produce products that people rely on. Brands like Charmin, Bounty, and Pampers are always needed in people's homes. If you want to keep your clothes smelling clean, you're also going to need Tide, Gain, etc. If you want to keep your body looking clean, you're going to need brands like Gillette, Head & Shoulders, and Crest, Pantene, etc. So you could see all those brands here. There are plenty more than just these. Procter & Gamble has continued to produce innovative products that people and consumers like to buy, not just need to buy. In terms of the financial picture here of Procter & Gamble, you've seen somewhat inconsistent but relatively good here in terms of free cash flow. Massive amounts of free cash flow. These businesses, Johnson & Johnson and Procter & Gamble, are among the largest in this consumer health type of space. Really good, old, and poised dividend payers with a 59.04% dividend payout ratio. This leaves roughly 40% of their net income to continue to do R&D, research and development, build new facilities, and market their products. Waste Management is next on our list, and this is the one company that continues to scare me, so to speak. This is a business that people will always need to have happen. Trash pickup, waste management is always really going to be needed. Now, will they go with waste management in the future? Will there be another company that steps into this space and instead does recycling or a cleaner, greener type of waste management? We will yet to see that. However, for the time being, 20 years of consecutive dividend increases, a 102% increase in their stock price over the last 5 years. Now, they do carry a good chunk of debt, 2.5 times net debt to EBITDA. However, their business is very diversified. They're not singling out residential. They're not singling out commercial or industrial. You can see here in the bottom right, this is the operating revenues, not profits, but operating revenues within these 3 different spaces. Growth from 2019 to 2021 in all 3, and relatively equal amounts of growth and relatively equal amounts of revenues from all 3 of them, of course, with commercial being their largest space. Now, let's take a look here at their financials. We have free cash flow really solid, not quite as much as Procter & Gamble and Johnson & Johnson, but nonetheless very healthy. We've also seen a 52.31% dividend payout ratio, meaning roughly 48% of their net income is still up for grabs to do whatever they need to do with it. Moving forward, we have Target, one that I feel is very underrated in the dividend income space. They have increased dividends for 52 years in a row and seen a 173% increase in their stock price. Now, their stock price has fell off the cliff that it was on, and this is a positive for me. I will continue to pump money into Target stock. Now, their net debt is slightly above that 1.5 times net debt to EBITDA. This is really probably because of those capital expenditures that they do have in terms of building new buildings, new facilities, sortation centers, and they do pay their employees very well. Now, that doesn't have too much to do with their debt. Of course, they're probably paying employees from free cash flow nonetheless. This is a business where people will continue to show up and show out. You need to shop no matter what the occasion is. Of course, there are other options, places like Kroger, and Walmart, but they don't quite have the customer appeal that Target does. Target also deals in all categories: grocery, home appliances, or I shouldn't say home appliances, but home products. You have clothing, you have seasonal things, you have delivery, you have makeup and beauty. All of these different spaces Target is involved in. They have really bolstered their from in-store to outside of the store car pickup. They have bolstered their 2-day delivery. They're going to continue to be a business that is going to be reckoned with, and with their track record of 52 years of dividend increases, I do not see that going anywhere either. Free cash flow is up and down, as I mentioned. They do have a lot of capital expenditures. They make big improvements to their physical stores, their physical buildings, remodeling, building new sortation centers, bolstering the business that they are in. I do not see this inconsistency as a bad thing, actually rather as a good thing. In terms of that dividend, it is very safe. They're only paying out 29.69% of their net income, meaning 70% of their cash can be used to remodel businesses, put more money into the businesses or the buildings that they already have, build new ones, and build out sortation centers that will bolster their own supply chain and help get that 2-day delivery to be a little bit more consistent. Last up on the list is none other than SCHD. 56% increase in this ETF price over the last 5 years. Nothing wild, but very good nonetheless. Now, the main reason I'm investing here and will always invest here in this ETF, diversification. This ETF has some of the largest companies in the world, some of the most stable companies in the world, some of the best dividend-paying companies in the world. In Merck & Co., Pepsi, Amgen, Coke, Verizon, Pfizer, you name it, they have it. BlackRock, Altria, 3M, US Bancorp. Very diversified. I love this ETF. I will continue to purchase this ETF, and mainly because the businesses that are held inside of it are right along with the likes of the businesses I've mentioned here. Target, Waste Management, Procter Gamble, J&J. Go right along with Coca-Cola, Pepsi, Merck & Co., Pfizer, Broadcom, Lockheed Martin. These are businesses people will continue to use. Now, there are some businesses within this that people will not use quite as much. Home Depot being one of the big ones. IBM potentially another one. But they make up 4%, 3% of this ETF. There are a lot of different positions within this ETF, so you're not singling out your exposure to a company that might not see increased revenues or increased earnings or really good financial times for the business, but you're diversified away from that, so it is not the biggest deal in the world when purchasing an ETF like SCHD. So that is this video. Those are the companies that I will be purchasing throughout a potential recession or really any economic conditions, not the companies that you should be purchasing, but use those companies as a starting point. Do your own research, dive further into the businesses mentioned here in this video, and go ahead and comment down below what businesses you will be buying. What stocks are you going to be purchasing over the next couple of years, no matter the economic conditions? Leave those in the comments below. Hit the like button, hit subscribe, hit the bell to be notified when a new video comes out, and I will see you all in the next one. Take care.